Stocks just suffered one of their sharpest sell-offs of the year. Hundreds of billions of dollars in market value erased in hours. Here's what happened. Donald Trump said the U.S. will double tariffs on all Chinese imports to 100%, beginning in November, while also restricting certain software exports to China's tech sector. In response, Beijing moved to tighten exports of rare earths, the crucial materials used in electric cars, smartphones, and even missile systems. Trump accused China of trying to, quote, hold the world captive, calling the country very hostile. He later said he hadn't officially canceled his meeting with Xi, but wasn't sure that we're going to have it. Financial markets reacted immediately. The Standard & Poor's 500 index fell almost 3%, its steepest single-day decline since the spring. This was a classic stagflation shock, the kind of event that raises prices while slowing growth. A 100% tariff is effectively a massive new tax on imported goods. Historically, these costs have not been absorbed by foreign companies. They've been passed straight on to American importers and consumers. That means higher prices at a time when inflation was already proving sticky and slower growth as businesses face uncertainty. It's a double hit to corporate earnings and household spending. The sectors hit hardest were technology and semiconductors, automotive and industrials, and retail. Meanwhile, safe haven assets like gold and the US dollar strengthened as investors rushed to safety. China's move is not random, it is strategic. First, it's about negotiating leverage. China dominates the global supply of rare earth minerals, not just in mining, but in refining and processing. By tightening export rules now, Beijing is signaling that it can control the flow of these materials, especially to industries tied to defense or advanced technology. Second, it's a mirror response to Washington's own export controls on semiconductors and advanced chips. The message is clear. If the United States restricts China's access to high-end technology, China can restrict America's access to the raw materials that power it. Third, this move is about domestic signaling. By escalating before the expected Trump-Xi summit, Xi Jinping can show strength at home, both to his party and to his public, while also putting pressure on the U.S. to concede in talks. The timing is deliberate. China's new export rules don't take effect until December, giving them room to negotiate but also keeping markets on edge. Allies are nervous. European and Asian partners want predictability and exemptions from new tariffs. Countries like South Korea, Japan, and Taiwan are caught in the middle, depending on both American tech and Chinese markets. Meanwhile, Australia and Canada may see new demand for their mineral resources as companies look to replace Chinese supply. Let's look at the possible consequences if this situation continues to escalate. First, supply chains. In autos and electric vehicles, rare earth magnets are essential for motors. If access tightens, we could see production cuts or higher car prices. In technology and semiconductors, export controls on both sides could cause shortages and production delays. In defense and aerospace, even small disruptions in specialty materials could delay weapons programs or raise costs. Second, the economy. A new tariff wave would almost certainly push prices higher. Economists call this tariff pass-through, meaning that nearly the entire cost of the tariff shows up in consumer prices. That would complicate the Federal Reserve's effort to bring inflation down while also discouraging investment and hiring. The result could be a stagflation scenario, slower growth combined with stubborn inflation. Third, the markets. Corporate earnings would be squeezed in sectors tied to global trade, especially technology, industrials, and retail. Companies with mostly domestic revenue and strong cash flow could outperform, while export-heavy firms may struggle. Safe haven trades like the US dollar, treasury bonds, and gold would likely stay firm. If both sides decide to cool down, we could see a mini-deal, similar to what happened in the first Trump term. That would likely involve Washington narrowing or phasing in tariffs or granting exceptions for consumer goods. Beijing, in return, could ease licensing for rare earth exports used in non-defense industries and tone down its investigation into American tech firms. A handshake, even a symbolic one, at the planned South Korea summit could be enough to trigger a relief rally in global markets. In the short term, expect more volatility. Headlines will move markets hour by hour. Traders are reducing position sizes, using options for protection, and staying defensive until the situation stabilizes. In the medium term, the focus shifts to resilience. Companies and investors that build exposure to domestic supply chains, alternative mineral sources, and energy infrastructure could benefit from the long-term policy trend toward self-reliance. For consumers, higher prices for electronics, vehicles, and appliances could show up quickly if tariffs stick. This moment marks a turning point. The trade dispute is no longer just about tariffs, It now includes technology, minerals, and defense. It's an economic confrontation with geopolitical consequences. Whether this escalates or cools off will shape inflation, interest rates, and global growth well into next year. As of now, the US and China appear to be testing each other's limits, and the markets are the first to feel the pain.